economy for a moment, because there are rising worries about a slowdown. You've got the Atlanta Federal Reserve saying we're going to have a contraction in the first quarter. Look, I know, are you expecting a recession this year?
I hate to predict things like that. There is a period of transition because what we're doing is very big. We're bringing wealth back to America. That's a big thing. And there are always periods of, it takes a little time. It takes a little time, but.
Hello, my YouTube family. Igor here to talk to you about some ETFs to consider because the market is crashing because of the tariffs, and the European Union and West Asia and Asia has not even responded to the Trump tariffs. So there will be more pain ahead until the market kind of stabilized. So here is at 5 of them. We're gonna talk about the T-bill, VGIT, BLV, FUTY, and S-Gold. So if that's all you needed, please go ahead and give me a like and subscribe to my channel. And but I believe the subsequent information will be good for you to add to your research. So let's get right into it. So the T-bill, this is a short-term treasury bill that can be sold at any time. During recessions or market crash, this is a safe way to park your money until the market becomes stable. This T-bill contains 99% of U.S. government bonds, which is backed by the U.S. dollar, and 0.33% cash. So also, if you look at it right at the bottom, you can see that the expense ratio is low, and you get a dividend yield every month of 4.92%. And right at the middle, you can see that it's consistently paid the dividends with no issue over the past few years. So the T-bill is a short term. So if you look at it right, I wouldn't look at that performance, but let's look at the 2023. The T-bill yielded a 5.3% increase on portfolio and 5.14 in 2024. And you look to your left, you will see that in the bonds category, it's performing relatively okay. So this is a risk-free investment. So the reward might not be as expected, but at least it has a safe return with these tumultuous market times. So the next one will be the VGIT. This is an intermediate government bond, and this one invests 99.5% of the government and 0.48% of cash equivalent. It also has a dividend yield of 3.64% and a very, very low expense ratio. So this is one to consider if you're looking at something intermediate, but I like short term, and I can get out and get back in and still have my dividend and my percent increase. So the VGIT, if you look at the long-term performance, since it's a short intermediate, I will look at the year-to-date and the one-year return. And the one-year return is 4.37%. If you combine that with some of the dividends, then that's worthwhile investing. And the year-to-date at this point is 2.22%. So if you look at the performance over the years, it performed relatively okay, versus their category, and this is intermediate. So if you actually invest in it as it's supposed to, not staying too long, you should be able to collect the dividends and still get an increase in value, and move your investments when market becomes stable. So another one is the BLV. This is a long-term bond ETFs, This fund invests 52.5% in government long-term bond, 44.53% corporate bond, and 2.30% municipal bond, and 0.79 cash equivalent. So this one has a yield, dividend yield of 4.47% and a very low expense ratio. So for you to get a good return on this one, you'll have to wait for a little longer. So you can see the distribution yield for the dividends, and it's been pretty consistent over the years. So imagine having 1,000 share and making that return of 4.92% or 4.47% per share monthly. It will yield a good return on a 1 year basis. So also the BLV, it's a safe way to park your money. The 1 year return it's 0.75%, and the BLV has a year-to-date return of 2.52%. This is not my favorite because of the performance and the annual total percent return over years is not, it doesn't really. I think you would break even on this one than make a good return on it, like VGIT and the T-bill. So when market is crashing, right, the regardless utility, it's still gonna be needed. Homes are gonna need electricity, water. So and FUTY is a Fidelity MSCY Utility Index Fund that track the index of stocks in the utility sector. So during market downturn, like I said, utility will always be needed, and you typically it performed well over the years when market was down. So it has a very low expense ratio of 0.08% and a yield of 2.82%. So it has a total holding of 52.2% for the top 10 holding, which it's a bit concentrated, but it still performed really well. And you can see some of the sectors that it tracks. So as far as performance, you can see that the 1 year return performance, it's at 25.42%, and the year to date it's at 2.26%, and the 3 year return is still at 6.7%. So in 1 year return is better than the S&P 500. And if you see over the annual total return percent history, you see that it performed relatively well over the past 8 years. You only have 2 negative years out of 8. That's a very good performance for an index. So the last one that I'm gonna talk about is the S Gold. This one is one of the best performing ETF. It tracks the spot price for gold. So there is no need with the S Gold. There is no need for physical gold. You can just invest into S Gold and it will track. It tracks the price. This one does not yield a dividend, but it's a really good performing stock ETF. It has a 0.17% expense ratio, and as far as performance, just look at that. The 1 year performance is at 36%, and it's performing really well. And the 3 years return is at 13.71%, which is great. And the year to date it's at 11.70%, which kind of went up a little bit more, because if gold is a safe way during recession that people move their money into, and you can kind of notice that with S Gold. because a lot of companies are moving, corporations are moving the money to escrow during these hard time in the market. And like I said, it's still gonna be a little bit up and down for the near future until everything is sorted out, the tariff situations are sorted out, and from there it's gonna start to rebound. So don't be fooled by dead cat bounce issues here. So the annual percent return, you can see how those perform. If you add up the performance over the past 8 years, it's you could have doubled your investment if you invested in S Gold in 2017. So this is all I have. And if you like my content, please like and subscribe. Like I said, I'm not a financial advisor. I'm someone on YouTube that like to do research and post my research for people to consider. So if you like my content and if you looked into some of those stocks and ETF that I talk about, please leave a comment and let me know which one you consider. And thank you so much for taking your time to watch my video. Peace. I'm out.